What's going on, Investomaniacs? Boy, Knight Rider here. So I already recorded and posted this video, but apparently people started commenting. They're like, there's no sound, and I guess I was too stupid to plug in my microphone. So yeah, I'm dumb. So I'm doing it again. We're doing it again. We'll do it live. I'll write it myself, and we'll do it live. To those of you who did see my original post, which had no sound, and were probably wondering why the first picture was some half-naked dude pouring dressing seductively on a very meaty salad, I'm not going to explain that. I'm just going to leave that as is. Anyway, today we're talking about Yum Brands, the company that owns Yo Quiero Taco Bell and Pizza Hut, KFC, as well as Wing Street. They recently reported second quarter earnings that were higher than Wall Street's expectations. The Kentucky-based conglomerate's shares popped up over 6%. According to CEO Greg Creed, that's the real illegitimate child of Apollo Creed. Just look at him. He's got the Apollo blood in him, brother. He stated, quote, "Second quarter results maintained early year momentum and helped us to exceed our already high expectations for a strong first half of 2019. Our commitment to being a more focused, more franchised, and more efficient growth company positions us well for long-term success." At Taco Bell, same-store sales increased by a beautiful 7%, topping Wall Street's expectations of only 3.75%. That's a hefty beat. And apparently every day is Taco Tuesday at Taco Bell. Taco Bell has consistently been Yum Brand's #1 growth performer. But hey, it's not just tacos y burritos bringing in all that moolah for Yum Brands. The finger-licking good KFC likewise experienced same-store sales increase of 6% against Wall Street's expectations of 3.68%. Also some solid growth there. Pizza lovers, too, are helping... actually not really so much. Wall Street was looking for a 1.1% same-store sales comp increase. Pizza Hut actually delivered 2% after inflation. That's about not. Pizza in general has been hit pretty hard by the expansion of delivery options in non-pizza restaurants via delivery aggregators like Grubhub and Uber Eats. More on Grubhub in a second. The fact that their same-store sales comps are remaining roughly even after inflation, I consider to be impressive, but that doesn't mean I want to be invested in this space, the pizza space. But Yum is a conglomerate, and as long as overall the company is doing good, it's okay if we have little weak points in there. And naturally, Pizza Hut is Yum's weakest point. But where delivery companies taketh away on one hand, they can also giveth on the other hand. Last year, Yum bought a 3% stake in Grubhub for $200 million. Although, as you guys know, I'm not exactly a fan of these new age delivery companies, so I can't say I'm a fan of that $200 million investment. Although there are some points in the business of Yum I don't like and or am concerned about, overall, I think it's a good company with a fair valuation. It's a buy. Up next, we've got Mastercard. The multinational financial services company announced last Tuesday that it has agreed to purchase the majority of Danish Net's corporate services business for 3.19 billion smackaroos. Mastercard's purchase of Nets comes with infrastructure that will permit account-to-account payments. This move is part of the Mastercard's bigger picture strategy of diversifying its payments capabilities. Mastercard also aims to take a larger share of cash and check-based transactions between businesses. According to Michael Maybeck, Mastercard Chief Product and Innovation Officer. Ooh, I love people called innovation officers. What do you do, Michael? I'm a officer of innovation. He says, quote, "To be a truly relevant one-stop shop, we can't just offer card solutions. This Nets deal is Mastercard's largest purchase in the company's 53-year history. It wants to continue being the largest player in the payments industry while further growing its real-time payment prowess. Of course, we're talking other than Visa. For years and years, Mastercard has mainly provided the infrastructure for credit and debit card payments. So what pushed Mastercard to make its largest purchase in its history outside of that core space? It's the growing risk that consumers will choose other payment modes besides credit and debit. And in a world of furthering cryptocurrencies, PayPals, Venmos, Cash Apps, it's a real concern down the line that traditional credit companies may ultimately get squeezed out. Moreover, Mastercard is ambitious enough to aim in becoming a big player in the humongous market of company payments. This market involves businesses moving cash between itself and one another. Thanks to the rapid growth of technology, times are changing, and this includes consumers' buying habits. Facebook, as an example, plans to initiate a cryptocurrency called Libra. Libra will permit customers to use a payment system based on blockchain. Even though both Mastercard and Visa are Libra partners, this may end up causing more harm than good to the overall companies, being that of Mastercard and Visa down the line. In Asia, mobile wallets Alipay and WeChat Pay are a couple of the more popular payment methods, which again, down the line may completely have no need for Visa and or Mastercard type processors. Efforts to change the way payments are processed are increasing as time goes on, and that's not good for the legacy companies if they cannot adapt. The Federal Reserve aims to develop a quicker payments system for banks and how these institutions exchange money. Large merchants and technology companies see this plan as the chance to enable cardless, real-time payments between merchants and customers. In the words of Charles Darwin, "It is not the strongest of the species that survives, not the most intelligent that survives. It is the best looking it is the one that is most adaptable to change." Thus far, Mastercard as well as Visa have done a pretty darn good job establishing partnerships with these new payment processors and new fintech type companies. But I do worry if their old services will not be needed in the future. Despite my long-term concerns, I still like Mastercard as well as Visa. For now, I do prefer Mastercard over Visa. There you guys go. We did it again. Hopefully it worked out the second time. That's it for this video. Let me know what your comments are. I appreciate all your likes and comments. Thank you so much. And make sure you subscribe to Investomania, brother.